Adobe is a cornerstone of the technology sector. For decades, its application software has been the quiet infrastructure behind global creative and corporate workflows. Right now, the market is pricing this blue-chip staple at a steep discount. Shares are currently trading at $210.98. That price reflects a very specific, pessimistic narrative. Investors are treating the company like a legacy tech brand whose best days of growth are firmly in the rearview mirror. But the raw financial data tells a different story. This visualization contrasts the current market sentiment with the underlying math. When we run a standard discounted cash flow model, the calculated intrinsic value comes out to $310.20 per share. This isn't based on aggressive projections either. The model relies on conservative inputs, a standard 10.9% weighted average cost of capital, and a modest 3.5% terminal growth rate. The difference between these two numbers gives us the margin of safety. At $210.98, the stock offers a massive 51.3% buffer against downside risk. To capitalize on a 51% margin of safety, you have to be willing to step away from the crowd. You have to bet against current market momentum and trust the strict accounting over daily price action. To understand why that 51% gap exists, we need to look at valuation multiples. These numbers show us exactly what the market expects to happen next. This scorecard graphic breaks down Adobe's valuation against its actual profitability. On the valuation side, the numbers are unusually low. The forward price-to-earnings ratio sits at 7.66, and the PEG ratio is just 0.56. Paying single-digit multiples for future earnings means you're buying the asset at a deep discount. The trade-off is that you are absorbing the sentiment risk from a broader market that is heavily betting against future growth. Now, look at the profitability column. The gross margin is nearly 90%, and the return on invested capital is 41.87%. An ROIC that high means the business operates as an incredibly efficient engine. It requires remarkably little new capital to generate massive profits. However, we have to weigh those elite margins against the current growth rates. Year-over-year earnings growth is 7.9%, and revenue growth is 12.7%. Because Adobe is already operating near maximum efficiency, it cannot squeeze much more profit out of its existing structure. Future wealth creation has to come entirely from new top-line revenue or from aggressive financial engineering. When evaluating financial engineering, free cash flow is the ultimate truth teller for a business's health, regardless of what the stock price is doing. This waterfall chart traces Adobe's free cash flow generation from fiscal year 2022 to the 2025 estimates, alongside how they spend it. Over this period, free cash flow surges from $7.4 billion to an estimated $9.85 billion. Earning nearly $10 billion in cash every year creates a specific corporate dilemma. If that cash just sits on the balance sheet, it drags down overall capital returns. Management is solving this by escalating their share repurchases. They've ramped up buybacks from $6.55 billion in 2022 to a staggering $11.28 billion in 2025. By buying back their own stock, they shrink the total pool of outstanding shares. This artificially boosts earnings per share and mathematically accelerates the intrinsic value per share for anyone holding the stock. But this aggressively engineered return comes with a clear trade-off. Over the same period, Adobe's end cash position actually falls from $7.61 billion down to $5.43 billion. Draining cash reserves at this rate introduces a strategic risk. It leaves the company with significantly less liquidity on hand if they need to execute major future acquisitions. Management is making a deliberate choice. They are intentionally sacrificing their M&A war chest to force shareholder value higher right now, heavily rewarding long-term holders while the stock price remains depressed. To see how those buybacks and earnings translate into future returns, we can look at forward EPS-based intrinsic value modeling. This scenario matrix compares our intrinsic value estimates across 1-year and 5-year horizons, factoring in conservative, moderate, and aggressive market environments. All scenarios are anchored against the current $210.98 price. Looking closely at the 1-year conservative model, the calculated value is $216.24. This shows the floor. Even in a worst-case, stagnant 12-month scenario, the stock mathematically retains a 5.47% margin of safety. The issue here is opportunity cost. Tying up capital for an entire year to see a negligible return is unappealing when a risk-free treasury rate guarantees you 4.44%. But watch what happens when we extend the timeline. In the 5-year moderate model, the value climbs to $357.08. Over 5 years, the compounding effect of steady earnings and those aggressive buybacks force a dominant 74.17% margin of safety. Time is the required catalyst here. The valuation will only correct in your favor if you commit to a strict 5-year holding period, giving the buyback engine enough runway to do its work. Backed by nearly $10 billion in free cash flow, the financial math points to one conclusion: Adobe at $210.98 is a fundamental bargain. This quadrant chart maps the kind of investor strategy required to safely buy this asset. We are charting short-term trading against long-term holding and deep value against high growth. The top left quadrant is for momentum traders and hyper-growth chasers. If this is your strategy, you should actively avoid this stock. Anyone requiring rapid price appreciation or accelerating 30% growth will be highly frustrated by Adobe's steady 7.9% earnings trajectory. The correct fit lies in the bottom right quadrant, long-term holding for deep value. The perfect buyer is a value or growth at a reasonable price accumulator. They want a wide moat, highly profitable machine, and they want it at a distressed 7.66 forward PE. Purchasing Adobe today is a highly calculated, low-risk opportunity. But it only works if you completely divorce your expectations from the high-flying tech momentum of the past and embrace the quiet, predictable compounding of deep value.